February 12th, 2026, 11:47 a.m. Eastern Standard Time. I'm looking at a crime scene. Silver just got assassinated in broad daylight. A 10% vertical drop. From $84 to $76 an hour. The weapon? A rumor. The suspect? Vladimir Putin. The accomplice? Your favorite financial media outlets lying directly to your face while the charts bleed out on the screen in front of me? The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. Do your own research if you still trust the people who stole your purchasing power, the same people who told you inflation was transitory in 2021, the same people who said Silicon Valley Bank was safe in March 2023, the same people currently telling you this crash is about jobs data. Jobs. Do your own research, meaning verify every single piece of data I'm about to show you, because I'm the only one showing you the actual crime scene photos, while Bloomberg puts a paywall between you and reality. I need you to understand what just happened, not the surface narrative, not the CNBC kayfabe. The actual mechanical reality of what occurred in the precious metals market between 9:30 a.m. and 11 a.m. this morning. Because if you don't understand the mechanism, you will panic sell your physical stack to a dealer who's been waiting for this exact scenario since December 2025. Let me paint the picture. Silver opened at $84.20 this morning, normal pre-market action. Futures were actually slightly elevated because yesterday we saw the Shanghai Futures Exchange report another drawdown in registered silver inventories. We're talking about a 4% decline in available physical metal in China's vaults. That should have been bullish. That should have supported the overnight bid. But at 8:31 a.m., exactly 1 minute after the Bureau of Labor Statistics released the January jobs report, the algorithms started their liquidation sequence. 130,000 jobs added. Unemployment ticks down to 3.9%. Wage growth moderating at 3.8% year over year. The headline reads, "Strong Jobs Report Crushes Recession Fears," and silver drops $2 in the first 5 minutes. That's the cover story. That's the narrative they want you to believe. Strong economy means no need for safe havens. Risk on, baby. Dump your gold, dump your silver. Get back into the NASDAQ because everything is fine and the Federal Reserve won't need to cut rates and hard assets are obsolete in this new paradigm of permanent prosperity. Except, I was watching the order flow. I was watching the volume signatures. This wasn't organic selling from momentum traders responding to jobs data. This was coordinated institutional liquidation with a very specific trigger, and that trigger appeared on my screen at 9:14 a.m., a Bloomberg terminal alert. Sources: Russia considering partial reversal of dollar ban for select energy trades. 13 words. That's all it took. 13 words to obliterate 10% of silver's value in the span of 90 minutes. Now smash the like button right now because YouTube's 2026 suppression algorithm is actively shadow banning content that questions official geopolitical narratives. I'm not joking. We tested this in January. Videos that mention BRICS de-dollarization got 40% less reach than videos covering generic ETF analysis. 40%. So if you want this information to reach anyone beyond the 3,000 people who've already clicked, you need to signal to the platform that this is valuable content. Hit the like, do it now. We're fighting an information war, and every engagement metric is a battlefield. Let me explain why that 13-word headline was a nuclear bomb for precious metals. The entire bull thesis for gold and silver since 2022 has been predicated on the collapse of dollar hegemony. Not inflation, not recession fears, not even central bank buying. The foundational narrative is that the United States weaponized the dollar through sanctions after Ukraine, and the rest of the world said, never again. Russia stopped accepting dollars for energy in April 2022. China started settling oil trades in yuan in 2023. Saudi Arabia let the petrodollar agreement expire in June 2024. The BRICS nations launched a partial gold-backed trade settlement system in October 2024. Every single one of those events was a brick removed from the foundation of fiat currency dominance, and every brick removed meant more flow into tangible assets. Gold went from $1,900 in early 2022 to $3,400 by January 2026. Silver went from $24 to $84. That's a 250% move in silver. A 79% move in gold. Those aren't normal bull markets. Those are monetary crisis valuations. Those are prices that reflect a fundamental breakdown in confidence in paper currencies. But if Russia reverses course, if Putin says, actually, we'll take dollars again for oil and natural gas shipments to Europe, that's a psychological reset. It means the de-dollarization thesis was overblown. It means the dollar might survive after all. It means maybe you don't need to own physical metal because the existing system isn't collapsing, it's just evolving, adapting, finding equilibrium. That's the narrative the algorithms bought this morning. And when I say algorithms, I mean the high-frequency trading systems that control 73% of precious metals futures volume on the COMEX. These aren't humans making thoughtful decisions about geopolitical developments. These are machine learning models trained on headline sentiment analysis. They scan Bloomberg, Reuters, Financial Times, Wall Street Journal. They parse the text. They assign probability scores to keywords: Russia, dollar, reversal, energy, and they execute trades in microseconds based on those probability weightings. So when that headline hit at 9:14 a.m., the algos saw Russia plus dollar plus reversal and immediately calculated a lower probability of continued de-dollarization. Lower probability of de-dollarization means lower safe haven demand for metals. Lower safe haven demand means sell silver futures, and they sold 47,000 contracts in the first 15 minutes. That's 235 million ounces of paper silver dumped onto the market before most human traders even read the full article. Let me do the math for you live because this is important. The entire global silver mining output for 2025 was approximately 830 million ounces. So in 15 minutes, the paper market traded the equivalent of 28% of annual global production. Not real metal, not physical bars changing hands in vaults. Just derivative contracts, synthetic exposure, numbers on a screen, but those numbers determine the spot price that every dealer uses to quote physical premiums. So, when you go to buy an actual silver eagle today, the dealer looks at the spot price of $76, which was set by an algorithm responding to a rumor about Russia and dollars, and that dealer adds a $6 premium, and you pay $82 for a coin that represents 1 ounce of actual metal that's getting scarcer by the week, according to every physical market indicator, from Shanghai to London to the COMEX registered inventories. You see the disconnect? You see the crime scene? The price discovery mechanism is completely broken, completely divorced from physical reality. And that brokenness is by design, because if the price actually reflected supply and demand fundamentals in the physical market, silver would be north of $150 right now based on the industrial demand surge from solar panel production alone. Let me give you 3 historical precedents for this exact type of price manipulation through narrative deployment. Write this down. Screenshot this. Verify every word. March 2008. Bear Stearns is collapsing. The stock drops from $93 to $2 in a week. Gold is surging because people understand this is a systemic crisis. Gold hits $1,030 on March 17th, 2008, and then the Federal Reserve announces a coordinated central bank intervention. A rumor circulates that the Fed will backstop all major investment banks. Gold drops $80 in 3 days. The narrative was crisis contained. The reality was that Bear Stearns was the canary in the coal mine, and 6 months later, Lehman Brothers vaporized and gold went to $1,900 by 2011. But that 3-day drop in March 2008, that was narrative management. That was an intentional deployment of coordinated messaging to shake out weak hands before the real move. September 2011, silver is at $43 after rallying from $18 in 2010. The narrative is dollar collapse, QE2, destroying currency values, physical shortages at the U.S. Mint. And then on September 22, 2011, the CME raises margin requirements on silver futures for the 5th time in 8 days, 5 times. They went from requiring $9,000 per contract to $21,600 per contract. That forced leveraged longs to liquidate. Silver crashed from $43 to $26 in 3 weeks, a 40% drop. The narrative was speculation reduction and market stability. The reality was targeted suppression of a parabolic move that threatened to expose the paper market's insolvency. March 2020. COVID lockdowns begin. The physical market goes into backwardation. You literally cannot buy silver coins or bars at any price in the United States. Dealers are sold out. The U.S. Mint suspends eagle production. And the spot price? The spot price drops from $18 to $12. How does that happen? How does silver get cheaper when you cannot physically obtain it? Because the COMEX paper market was liquidating futures contracts to raise cash for margin calls in the equity market. The mechanism was a cross-asset liquidity cascade. Hedge funds needed dollars immediately. They sold everything: stocks, bonds, gold, silver. Didn't matter, just convert to cash. And the spot price, which is set by futures, crashed while the physical premium exploded to $10 over spot. Those 3 examples teach you the playbook. When there's a genuine systemic stress event building, the powers that be will deploy a narrative to create a temporary price drop that shakes out weak hands and allows insiders to accumulate physical at suppressed levels. The Bear Stearns intervention narrative bought them 3 days of lower gold prices before reality reasserted. The CME margin hike bought them 3 weeks of lower silver prices before the market adapted. The COVID crash bought them 6 weeks of disconnected pricing before physical premiums forced spot prices higher. And today? Today we got the Russia rumor. The question is whether this is a 6-hour shakeout, a 6-day shakeout, or a 6-week shakeout. And to answer that question, we need to determine if the rumor is real. So, let's examine the sourcing. Bloomberg said, sources familiar with the matter. That's anonymous. That's not Kremlin press release. That's not Putin standing at a podium saying we will accept dollars again. That's sources. In journalism, sources can mean a junior staffer at the Russian finance ministry who heard a rumor in the bathroom. It can mean a Western intelligence asset deliberately planting disinformation. It can mean a commodities trader who wants to profit from a short-term price move and called his buddy at Bloomberg with a fake tip. I went back through the Russian government's actual official statements from the past 6 months. December 2025, Putin at the BRICS summit in Kazan. The era of dollar dominance is ending. We will build a multipolar currency system. January 15, 2026, Russian Finance Minister Siluanov. All energy exports to non-friendly nations will be settled in rubles, yuan, or gold. This policy is irreversible. February 3, 2026, just 9 days ago, the Russian central bank announced they're increasing gold reserves by another 200 tons this year. Do those sound like the statements of a government about to reverse course and start accepting dollars again? Do those sound like the policies of a nation that's capitulating to Western financial pressure? Or do they sound like the exact opposite? Here's what I think happened, and you can call me a conspiracy theorist, but I want you to watch what happens over the next 72 hours and tell me if I'm wrong. I think a Western intelligence service, probably coordinating with major bullion banks that are short silver futures, planted this rumor specifically to create a sell-off before the weekend. Why before the weekend? Because it gives them 2 full days of no trading to let the narrative marinate, 2 days for casual investors to read the headlines and panic, 2 days for weak hands to call their brokers on Monday morning and say, sell my SLV shares. And while that's happening, what are the insiders doing? They're buying physical at $76. They're covering short positions at a 10% discount. They're accumulating inventory before the rumor gets officially denied and the price gaps back up to $83. Let me show you the technical setup that makes this even more suspicious. Silver was approaching major resistance at $85. That's the level where we saw massive selling pressure in November 2025. Every time silver tried to break $85, it got rejected. So we've been consolidating between $78 and $84 for the past 2 months. That's a textbook bull flag pattern, textbook continuation setup. And continuation patterns resolve in the direction of the prior trend, which is up. So if you're a bullion bank that's short 200 million ounces of paper silver, and you're watching the price coil tighter and tighter below resistance, what do? You can't let it break out above $85 because that triggers momentum algorithms and retail FOMO, and suddenly you're facing a gamma squeeze situation where you have to cover shorts at $95, $105, $120. You need to break the pattern. You need to create downside volatility that kills the bullish setup and scares away the momentum traders. How do you do that? You plant a rumor. 13 words. Russia considering partial reversal of dollar ban for select energy trades. The algos do the rest. 47,000 contracts sold in 15 minutes. Price drops 10%. Bull flag destroyed. Weak hands shaken out. Mission accomplished. Now here's where it gets even more interesting. While silver was dropping, I was watching the US Treasury market. The 1-0-year yield barely moved. It went from 4.23% to 4.26%. That's 3 basis points. 3. If the market genuinely believed the jobs report was strong and the economy was resilient, and the Fed wouldn't need to cut rates, you'd expect a much bigger move in yields. You'd expect the 1-0-year to spike to 4.35%, 4.4%, because strong economy means higher inflation risk means higher yield demands from bond investors. But yields didn't move. The dollar index went up slightly, from 107.2 to 107.8. That's a 0.5% move. Modest. Not the kind of dollar surge you'd expect if the market thought de-dollarization was dead and dollar hegemony was restored. The equity market? S&P 500 went up 0.3%, barely noticeable. NASDAQ up 0.4%. These are not the moves of a market that just received confirmatory evidence that the global financial system is stable and the dollar is secure. The only asset class that moved violently was precious metals. Gold dropped 3.2%, silver dropped 10%, platinum dropped 4.1%, and mining stocks? The GDX Gold Miner ETF dropped 6.8%. Why? Why would mining stocks drop harder than the metal itself if this was about fundamental economic strength? Mining stocks are leveraged plays on metal prices, yes, but they're also industrial companies with real earnings and dividends. If the economy is strong, that should support mining equities, even if metal prices dip. Unless the move wasn't about economics at all. Unless it was a targeted strike on a specific sector using a specific narrative weapon. And that's exactly what this looks like. Surgical, precise, isolated to metals while the rest of the market barely reacted. Before I go further, I need you to comment right now and tell me what physical premiums look like at your local dealer today. This is critical field intelligence. When the paper market crashes but physical supply remains tight, that's the tell. That's how you know the price drop is artificial. So go to the comments, type your city, type the premium your dealer is quoting over spot for silver eagles or maples or whatever government bullion they stock. I'm compiling this data because if premiums haven't dropped, if dealers are still charging $5 to $8 over spot despite the 10% price decline, that means physical buyers aren't panicking. That means the sell-off is entirely in the paper futures market. Let's talk about the jobs report for a minute because that's the official explanation and we need to dismantle it piece by piece. 130,000 jobs added in January. The headline number looks solid. But let me show you what's inside that number. 89,000 of those jobs were in healthcare and social assistance. That's government-adjacent employment. Hospitals, nursing homes, home health aides. A lot of that is funded through Medicare and Medicaid, which means it's ultimately taxpayer-supported. Another 23,000 jobs were in leisure and hospitality. Restaurants, hotels, bars. These are low-wage, high-turnover positions. So out of 130,000 jobs, 112,000 were in healthcare and hospitality. That leaves 18,000 jobs across the entire rest of the economy. Manufacturing added 4,000 jobs. That's a rounding error. Construction lost 7,000 jobs in January. Negative. Retail lost 11,000 jobs. Also negative. Professional and business services added 12,000, but that category includes temp agencies, which is not exactly a sign of robust full-time employment demand. This is not a strong jobs report. This is a mediocre jobs report being spun as strong because the White House needs a win, and the Federal Reserve needs justification to hold rates steady at 4.75% instead of cutting. But the composition of the job gains tells you the real economy is struggling. People are taking healthcare aid jobs and restaurant jobs because they can't find employment in higher wage sectors. And here's the kicker. The household survey, which is what they use to calculate the unemployment rate, showed a decline of 31,000 employed people in January. The establishment survey said plus 130,000. The household survey said negative 31,000. That's a 161,000 discrepancy. They use the establishment survey for the headline because it looks better. But the household survey is actually more accurate for capturing gig economy work and self-employment, and it's showing contraction. So the strong jobs report is a statistical artifact, it's data massage, and even if we take it at face value, a single month of decent employment data doesn't change the trajectory of an economy carrying $36.2 trillion in federal debt, running a $2.1 trillion annual deficit, facing $175 billion in monthly interest payments on that debt. The math doesn't work. It never worked. And one jobs report doesn't fix insolvency. But that jobs report was useful. It provided cover for the real trigger, which was the Russia rumor. The mainstream financial media could say silver dropped on strong jobs data, and normies would nod along and think, oh, that makes sense. Strong economy means less demand for safe havens. Meanwhile, the people who actually understand market mechanics saw the timestamp. They saw the Bloomberg headline at 9:14 a.m. They saw the volume signature. They know what happened. Let me walk you through the order book dynamics, because this is where it gets technical, and this is where you see the fingerprints of institutional manipulation. When silver futures started dropping, the first sell orders were large blocks. 500 contracts. 1,000 contracts. These aren't retail traders panic selling their 5-contract position. These are institutions. And they weren't just selling at market, they were layering sell orders below the bid, intentionally creating downward pressure. At 9:28 a.m., spot silver was at $82.10. There were sell orders stacked at $82.05, $82, $81.95, $81.90, all the way down. That's called painting the tape. You create the visual appearance of overwhelming sell pressure to trigger stop-loss orders and momentum algorithms. And it worked. At 9:31 a.m., silver broke below $82. That triggered stops. More selling. Price drops to $81.50. More stops triggered. More selling. By 9:45 a.m., we're at $79. By 10:15 a.m., we're at $76. This is a liquidity cascade. This is a mechanical flush where each level of support gets broken and the break triggers more selling, and the selling breaks the next level of support. It's a feedback loop. And it's extremely profitable if you're the entity that initiated the cascade, because you can cover your short positions at progressively lower prices and then flip long at the bottom and ride it back up. Here's how you know this was orchestrated. At 10:43 a.m., after silver hit the $75.80 low, the selling stopped. Immediately, like a faucet turning off. No gradual deceleration, no tapering of volume, just instant cessation of sell pressure. And at 10:44 a.m., big buy orders started appearing. 800 contracts at $76.20. 1,200 contracts at $76.50. By 11 a.m., silver had recovered to $78. That's not organic market behavior. Organic sell-offs don't have clean bottoms. They're messy. There's back and forth. There's retests of the low. This was a controlled demolition followed by an equally controlled accumulation phase. Somebody sold it down to $75.80 and then immediately started buying it back. And that somebody has more capital and more information than you do. Who benefits from this? Follow the money. The four largest bullion banks on the COMEX are JP Morgan, HSBC, Scotiabank, and UBS. These banks collectively hold short positions equivalent to 380 million ounces of silver. That's 46% of annual global production. They are structurally short. Their business model is selling paper silver to investors and hedging with minimal physical inventory. As long as the price stays suppressed, they're profitable. If the price breaks out and runs to $120, they face billions in losses. So they have a vested interest in preventing breakouts. They have a vested interest in creating volatility that scares retail investors away from the sector. And they have the tools to do it. They have direct access to COMEX trading systems. They have relationships with media outlets. They have algorithmic trading systems that can execute complex strategies in milliseconds. And most importantly, they have the backing of central banks who do not want gold and silver prices signaling a loss of confidence in fiat currencies. This isn't speculation. This is documented. In September 2020, JP Morgan was fined $920 million for spoofing precious metals markets. Spoofing is when you place large orders to create the appearance of demand or supply and then cancel those orders before they execute. It's market manipulation. And JP Morgan did it thousands of times between 2008 and 2016. They got caught, they paid a fine, and then they went right back to doing it because the profit from manipulation exceeds the cost of the fines. The Department of Justice press release from that case literally said JP Morgan traders placed orders to buy and sell precious metals futures contracts with the intent to cancel those orders before execution in order to inject false information into the market. False information. That's the US government's language, not mine. The government admitted that major banks were injecting false information into precious metals markets. And you think they stopped in 2016? You think a $920 million fine changed the business model? No, they just got more sophisticated. Instead of obvious spoofing patterns, they use narrative deployment. They use coordinated headline drops. They use algorithmic trading strategies that are technically legal but achieve the same market-moving effect. That's what we saw today. A narrative weapon deployed at a specific time to achieve a specific price target. The jobs report was the cover. The Russia rumor was the payload. The algorithm-driven sell-off was the delivery mechanism, and the result was a 10% price drop that allowed shorts to cover and insiders to accumulate. Now let's talk about what happens next. Because the narrative has been deployed, the damage has been done, weak hands have been shaken. The question is whether this rumor has legs or whether it gets debunked in the next 48 hours. If Russia officially denies the story, if the Kremlin puts out a statement saying, "We have no plans to accept dollars for energy exports," then silver gaps back up Monday morning. We could open at $82, $83, the entire drop gets erased, and the people who panic sold their physical at $76 will watch the price recover and realize they just gave their metal to a dealer for 10% less than it was worth 24 hours ago. If Russia stays silent, if they don't confirm or deny, then the uncertainty lingers. The market will trade based on speculation. We might see continued chop between $76 and $80 while traders wait for clarity. That's the scenario where physical buyers have the most opportunity because premiums will stay elevated while spot remains depressed. If Russia actually confirms the story, if Putin comes out and says, yes, we are accepting dollars again for specific trade deals, then we have a different situation. That's a genuine shift in the de-dollarization narrative. That would support a move back to $70 or even $65 in the near term. But even then, it doesn't change the long-term thesis. Even if Russia accepts dollars for some trades, China isn't. Saudi Arabia isn't. The BRICS payment system is still being built. Central banks are still buying gold at record rates. The Bank of China added 18 tons of gold in January 2026. That's on top of the 225 tons they added in 2025. The Central Bank of India added 12 tons in January. Poland added 11 tons. These are official reported purchases. The actual buying is likely higher because central banks have been purchasing through intermediaries to avoid moving the market. This is documented fact. The World Gold Council publishes this data quarterly. So even if the Russia rumor is true, even if de-dollarization slows or pauses in one specific area, the macro trend is still toward currency diversification and hard asset accumulation by sovereign actors. That supports higher gold prices long term. And silver follows gold. Silver always follows gold, usually with 3-to-1 leverage on the move. Here's the play. If you believe the rumor is false or overblown, this is a gift. This is a 10% discount on an asset that was in a bullish consolidation pattern before the manufactured sell-off. You buy physical at $76 plus premium. You dollar cost average. You don't use leverage. You don't buy paper SLV that can be manipulated. You buy coins or bars from a reputable dealer and you store them yourself. If you believe the rumor is true and de-dollarization is reversing, you wait. You let silver bottom wherever it's going to bottom. You watch for stabilization, and then you reassess the thesis. But I want to be clear. If you're selling your physical stack right now based on a 13-word Bloomberg headline citing anonymous sources, you are doing exactly what the bullion banks want you to do. You are giving them your metal at a discount. I've been buying this dip. I'm not waiting. I called my dealer at 10:30 a.m. when silver was at $76.80, and I locked in a price on 200 ounces, Silver Eagles, $82 per coin. That's a $5.20 premium over the depressed spot price. In 6 months, when silver is at $110, I'm not going to care whether I paid $82 or $88. I'm going to care that I had physical metal in my possession instead of exposure through a paper ETF that can be frozen or liquidated in a systemic crisis.